This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
By 1990, it got worse. It was $646. And then now it's about $1,900 a month, right? That's in what's called nominal dollars. That's just the name of the dollars. It's meaningless. If we adjust them for inflation, though, according to the official statistics, then we see not 520 in 1980, we see 241. And today we see it's $257 per month adjusted for the consumer price index inflation rate. So it is almost double in real dollars or constant dollars of what it was 52 years ago.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. Now, if you've been following the show for any length of time, you know that I love building that bulletproof cash flow, not only for today, but also for the future, for later in life. Now, depending on your plan, you can choose to build that generational wealth, or you can allow yourself to retire with properties and that generate some reliable income for the winter of your life. Now, part of this is understanding, though, what is happening today, what is happening in today's market that's really going to define what you're going to be doing in the near term or possibly even in the long term. Well, our next guest knows all about this. He started his career in real estate at the age of 19, brokering properties for clients while building his own portfolio along the way. Now, since then, he has been involved in several thousand real estate transactions and has personally owned income properties in 11 states and 17 cities. Now, he's become one of the top realtors in the U.S. He's made millions of dollars and has earned a number of industry awards. He reaches hundreds of thousands of people worldwide with his Creating Wealth podcast and is a sought-after speaker and educator. Now, today, he is the founder of Platinum Property Investment Network, where he helps people achieve their dreams of financial freedom by purchasing income-producing properties in prudent markets nationwide. Now, with all that, I'd like to welcome Jason Hartman to the show. Jason, buddy, thanks for coming on, man.
Thanks, Augustino. It's great to be here, and I hope I can impart some ideas and some data that will help people determine or help them understand where the market is going and more broadly where the economy is going, because we are in a crazy time right now, a time of extreme change. Yeah.
Yeah, well, I have no doubt you'll be able to impart a lot of wisdom here. Now, guys, if you like what Jason has to say, you can reach him via his contact page at jasonhartman.com. We'll include a link in the description. Okay, Jason, go ahead and tell us a little about your backstory first, a little bit about your journey, how you got started on that and all this, and then we can talk a little bit about what you think the future holds.
Yeah, certainly. So I started in traditional real estate my first year of college. I wanted to learn how to be an investor, and I bought my first property when I was 20 years old and kept building my portfolio from there. And then I acquired a real estate company. I sold it to Coldwell Banker back in 2005. And since then, I've really been helping investors buy properties and build portfolios nationwide in good linear markets. We basically divide the country or the entire world into three types of markets: linear markets, cyclical markets, and hybrid markets. Of course, in a country as large and diverse as the United States, there are nearly 400 MSAs. There's over 3,100 counties. There's over 9,000 cities and countless neighborhoods or submarkets. So it's a very big country. All real estate is local. And what we do is we research markets around the country, but even around the world to a lesser extent, and help people buy properties in these markets that really just make sense from an investment perspective. And we do a lot of research. One of the things I did more recently in the last couple of years is I developed my own index to help people understand if real estate is overvalued or undervalued. It's called the Hartman Comparison Index. And it answers what I think is life's most important question, which is compared to what?
Yes.
And that's what we do when we value real estate. And so, I can go through some of that stuff with your audience today.
Absolutely. Absolutely. So it's funny because I always envision it as two types of markets, where it's a cash flow market and an appreciation market, but you have a different approach too. Yeah. I think it sounds like you're just calling it's the same thing, but you're calling it two different things. But then you also add hybrid market. Now, before we go on, the hybrid market is, I imagine it's kind of like a mix between a cash flow market and a appreciation market. Is that right?
Yeah. Yeah, it would be a mix between the two.
Interesting. What would drive that? Is it like a shift that happens? Is it a cycle that happens between that? Like, how does that work?
Well, let me just identify these three different types of markets. And you know what? I can actually do this with some good visual aids here. Let me just get them for you, and I will share them on my screen. And for people listening on audio only, we will explain it so that it all makes sense to you. Because, as the old saying goes, a picture says 1,000 words. So we'll really kind of drill down and kind of explain this. But the difference between linear, cyclical, and hybrid markets is palpable. And it's really important that people understand this because it influences a lot of the investment decision, and people can really get themselves into trouble or save themselves a lot of trouble by doing this. And you know what? I said that, but I can't find it at the moment. So I didn't think we were going to go into that. But just suffice it to say this. I grew up in Los Angeles, California. Most of the West Coast of the United States and the expensive northeastern markets in the U.S. and South Florida, where I live now. I live in Palm Beach, Florida, and south of me is Fort Lauderdale, Miami. All of those markets are cyclical markets. They are the markets that get all the attention. They make the news, they make the headlines because they're sensational. And if you're looking at a chart of real estate appreciation or depreciation over time, they have glorious highs and really ugly lows. They look like a roller coaster. Those are cyclical markets. Around the world, there are many cyclical markets that are also the sort of trophy markets, the markets that get all the attention. Examples would be London, Paris, Dubai, Hong Kong, okay? Those would be cyclical markets. But most of the world and most of the United States is a linear market. And those are markets that are kind of boring. They just get really good cash flow. They don't have extremes of highs and lows. And then hybrid markets are in between the two. Okay, so examples of hybrid markets would be places like now, formerly linear market. Atlanta, Georgia is now a hybrid market. Tampa, Florida is hybrid. Austin, Texas, Denver, Colorado. Those are great hybrid market examples. Okay, and again, the vast majority of the world in the United States is just linear. Okay, and those linear markets we think are really the best investment choices, because nobody can time the market with really a lot of accuracy. I mean, I've been doing this a long time, and that's what I found. And so you're better to rely on yield and be a yield-oriented investor that invests for yield or cash flow, because that is extremely reliable, whereas appreciation or depreciation, hard to predict.
Yeah, no, listen, I agree 100%. That's the thing about here in Cleveland, for instance, it's one of those linear markets, very boring, get cash flow. We are seeing appreciation, I think, like everywhere else, when it comes to the rents and some of the appreciation coming into the cost of assets, which is why, at least for us, anyway, we're doing more development than acquisition. But I believe anyway, the people that aren't necessarily in the know, using the air quotes, in the know, they're getting shiny object syndrome. Everybody's talking about LA and Florida and all these different places, and they're just like, oh wow, I'm gonna buy into this syndication here. I'm gonna make tons of money because, just like you said, you have these glorious highs, but those lows are real ugly, and that's what you risk.
The good comparison for those would be fool's gold.
Yes,
in the era of gold mining, when everybody ran to California to go mine for gold, fool's gold, right? It's shiny, it looks good, but it can waste a lot of your time and money looking for it. Yeah,
that's right. So it really is scary, but but it sounds like you're on the same page as I am anyway. It's like in terms of just finding and staying in those linear markets, those are phenomenal. But it sounds like those hybrid ones, they're kind of like in the middle. So I guess it sounds to me like that can go either way over time, right? Eventually, right now, like Atlanta, you mentioned, is like a hybrid market, because at one point it was mostly linear. Now it's more hybrid because there's a lot of attention on it, but it can also eventually fall back, right? I imagine, right? Hey, Augustino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me.
Well, we've been doing business in Atlanta for well over a decade. I've been helping investors buy there. And it is now, given this crazy market, I would consider it a hybrid market. But, we might want to look at a little bit of statistical information on housing inventory, for example, to kind of determine, what we think is going to happen next with the market. And then also take a look at some samples of my index, which is called the Hartman Comparison Index, or the HCI. And I think it'll be really enlightening for your audience. So I'll go ahead and just share this now. So when you look at housing inventory, it depends what survey you're looking at, because they all have different ways of calculating this. So if you hear different numbers and you're following, for example, the National Association of Realtors, or NAR survey, that's different than the one I'm going to use today. This is Altos, and I like their data because they're simply taking every property listed for sale in the multiple listing service in the country, and if it's for sale, not a contingent sale, not a pending sale, it's considered inventory. And I think this is really the best way to look at it. But it doesn't matter which survey you're using, as long as you're consistent, so you're comparing apples to apples over time. That would be the most important thing. So we started off the year with very low inventory. In fact, the lowest ever for the start of a year, with 293,000 homes for sale. Very low inventory. So this chart, looking back to 2015, you see that it was about 1.2 million homes, and it's just gone down from there. By the end of the first quarter, inventory got even lower. It was only 241,000 homes for sale. So that was like walking into the grocery store and seeing 66% to 80% of the shelves empty. That was the housing market. Now, we've had very significant spikes in interest rates, and that has caused inventory to increase quite dramatically. So let's take a look at that. So as of about 2 weeks ago, we had about 418,000 homes for sale. A big increase, but still historically very, very low. It depends who you ask. But most experts will say a quote unquote normal market, normal inventory levels would be 1 million to maybe 1.5 million homes for sale. So you can see we are still very, very low in terms of inventory numbers. And since then, it has gone up even more. We're at about 490,000 homes for sale now. So inventory is definitely increasing. No question about it. And it's increased pretty fast, but it's still far below historical levels. We have about 2 months of inventory for sale at current absorption rates, and a normal market would be considered about 6 months. So we got about 1/3 of normal by most standards. So inventory is very, very low overall, but it is rising. So we will continue to monitor the situation and see how it goes. Okay. We just don't know where it will be, but it is very, very low now.
Right. So when you saw this last increase in interest rates, were you able to see it happen? I mean, I don't know how up to date your data is, but were you able to see that happen in terms of housing availability, or did anything even change?
Oh yeah, it changed very, very quickly, and as that changed, the interest rates went up and the inventory went up. I mean, it was about a month where the buyers really sort of put things on hold, and really wondered what was going to happen. Where's the market going? But if we look at this in its historical context, amazingly, and this may be totally amazing to some people, amazingly, real estate is much less expensive than most people think. And I'll just give you a couple of examples of this, Augustino. One of the reasons people think real estate is so expensive is because they're only comparing it to one thing. And this causes a lot of blind spots. What is that one thing? It's the US dollar. And the US dollar, as we all know, is a moving target. I mean, think about it. During the pandemic, they printed trillions of US dollars. They created them literally out of thin air. So why wouldn't the dollar be a moving target? Why would we expect the dollar to be some stable unit of account or unit of value? We can't. So we've got to use multiple measuring sticks in order to determine the true value of anything. I mean, we've all experienced massive inflation. None of us can believe it. I mean, look, someone like you, someone like me, we have money, we have resources. So it's just sort of an annoyance to us. It doesn't change our life at all. But for the vast majority of Americans, this inflation we've experienced is life-changing in a very negative way. And I feel terrible about it. I mean, listen, I grew up poor. I know what it's like to be poor. All of my childhood was spent without much in the way of resources at all. It was only, when my adult life started that I became successful and had resources and money. So this inflation is crippling a lot of people. So in order to understand the value of real estate, we've got to compare it to a lot of things. And I'm always on my podcast and on my YouTube channel asking this question that I think is life's most important question. And the question is, compared to what? And my listeners even dubbed it the Jason Hartman question because I say it so much. Clearly, I did not invent the question.
Right.
But I did create an index around it. And it's called the HCI, or the Hartman Comparison Index. And so here's an example. I'm not a gold bug. You probably aren't either. Maybe some people in your audience really like gold. But the one thing we can agree on is that gold has been considered money for about 5,000 years. And it is a measuring stick. It's a reasonably valuable measuring stick. And so let's compare gold to the price of a home historically. And let's look at that over the last 52 years. And so let's look at it mostly over the last 50 years, because something very important happened 51 years ago. And that was that Nixon closed the gold window, took us off the gold standard in 1971. Okay. So I'm going to use 1972 at the end of the second quarter because gold prices began to float and the market almost doubled them from when Nixon took us off the gold standard. Okay. And back then, the median price home was about $27,000 and gold was $65 an ounce. So if you wanted to buy the median price home in gold rather than dollars, in dollars, you would have paid about $27,000. In gold, you would have paid about 412 ounces of gold. But today, and keep in mind, this is the end of last quarter. I know this stuff moves around pretty quick. It can never be totally up to date. But, today, when the median price house is about $360,000, give or take, gold is almost $2,000 an ounce, it would be 184 ounces of gold to buy the median price house. So priced in gold, is housing cheap or is it expensive? Well, it's actually cheaper than it was 52 years ago. That might amaze some people. They think it's expensive because they're comparing it to a moving target called the US dollar that's losing value all the time. Okay, that's gold, but let's use something else. Let's use one of the most valuable commodities in the entire world, a commodity that quite literally the industrialized world lives on. Forget about what all the green people say, wind, solar, yada, yada. The world runs on oil, whether you like it or not. Oil is one of the most important commodities to the entire human race.
I want to take a pause from today's show to share something that I've been encountering. As I speak to many investors, there's this concern, and the concern is centered around the inflation we've been experiencing and the devaluation of our currency. Now, we've seen some of the highest inflationary periods over the past 30 years. That's up over 8%. Economists actually believe that inflation is closer to 20%. Some say it's even more. Now, what does this mean for you? Well, it means that money that is sitting in your bank account or self-directed IRA that's not invested in physical assets that hedge against inflation are losing buying power. That means that every minute, every second, that dollar is becoming less valuable. You see this every day. You see this in the groceries you buy, the gasoline you buy, everyday items that you're buying on a daily basis are becoming more and more expensive, and you're using a less powerful dollar to buy these items, meaning that dollar is losing value if it isn't put into a property that produces cash flow, just like real estate does. Now, our team here at Bulletproof Cashflow has put together a series of weekly webinars that cover real estate investing like multifamily, net lease, and real estate development. Now, these are purely educational webinars. In these webinars, we talk about why real estate offers a powerful opportunity right now and why it makes sense to invest in these assets today. So, if you're interested in real estate or want to have the opportunity to get involved as a hedge against inflation yourself, I encourage you to go to bulletproofcashflow.com/webinars. That's bulletproofcashflow.com/webinars. Now you go there, these webinars are 45 minutes and they cover different topics every week. We go over the things you need to know to avoid some of the common pitfalls when it comes to investing while getting you prepared to invest your paper dollars into a real physical asset. Now, if you can't make the webinars, just go ahead and register and we will send you a recording that you can watch at any time. And by the way, these webinars are entirely free. There's no cost to you. This is just something that we do to educate our folks out there. So if you're enjoying this episode, please like and subscribe to Bulletproof Cashflow. It helps the channel tremendously when you do. Now let's go ahead and get back to the show.
And if we compare real estate prices to oil, how does it look? How does it look? Well, 52 years ago in 1970, the median price house was about $23,000. Oil was $4 a barrel. And it would cost 6,400 barrels of oil to buy the median price house. By 1980, the house price had almost tripled in dollars, and it escalated by almost 10x in oil. It was only 1,700 barrels of oil to buy a house 10 years later. And then in 1990, we see that the price of everything changed again. It was about 3,500 barrels of oil to buy a house. Today, it's about 3,300 barrels of oil to buy a house. Why does this matter? Some people might be asking, Jason, look, I don't save money in oil. I don't save it in gold. I save it in dollars. If I want to buy a house and I'm saving money, well, really you have a choice. You could save money by simply converting your paycheck to dollars, putting it in the bank account, and letting it rot or letting inflation eat it up. Or you could buy gold futures or oil futures, or you could buy the hard commodity, right? There's lots of ways to save money and store wealth. And if you save it in dollars, one thing is for sure, it will lose value, at least historically. And probably going forward, it's going to lose a lot more value because I think a lot more inflation is coming as bad as it's already been. Okay, but here's the thing. most people don't buy a house for cash. They buy it based on a payment. They buy it with a mortgage. So how does this look if we look at it in terms of a mortgage payment? We know that based in oil and based in gold, it's actually quite cheap. And if we think there's going to be a housing correction or a crash, we've got to ask ourselves, how burdened is the typical homeowner? And I say they are surprisingly unburdened. As much as people want to say people can't afford it, it's too expensive. The facts are the facts, and here are the facts. Here's a chart from the St. Louis Federal Reserve, the FRED website that almost everybody uses who's, measuring the economy. And this is a chart that shows the mortgage debt service payment burden as a percentage of disposable income for a typical household. Now, a year ago, it was the lowest it's been probably since they've been measuring it. And I'll show you the full chart in a moment. It was very low because housing prices hadn't increased yet by much, and mortgage interest was literally the lowest it's been in 5,000 years. And yes, they have been measuring interest rates for 5 millennia, believe it or not. Great recommendation by the late David Graeber. It's called Debt, the First 5,000 Years. Fascinating book. There's a very long history on interest rates. So now this debt burden has increased compared to a year ago substantially. But what if you compare it to 2015 and go back further? It's gone lower and lower and lower. It was lower last year, but it's still historically very low today. How about if we compare it to the 80s? Let's go way back to about 1984, 1983. And you see that the debt burden now, mortgage debt versus disposable income, is very low. If you're going to have a crash, you got to have a lot of overburdened homeowners. 24% of the mortgages in the country right now are below 3% interest. Those people are not overburdened. They have a deal of a lifetime. And they are going to fight to keep those mortgages, because if they sell that property or lose that property through foreclosure, they're going to lose the mortgage, which is actually a huge asset. So it's really interesting when you look at this stuff, and rather than just listening to like offhanded comments, housing is actually surprisingly affordable, believe it or not. And I can share lots of examples of this, but you probably have some questions or comments you want to make.
Oh, absolutely. No. And I totally agree that we've printed money into oblivion, these worthless pieces of paper that I keep a stack of it right here. It's just, this is play money. It's just as worth the same as the money you probably have in your pocket right now, right? It's the same thing. And, it only has value when it's being used. Why not use it on another asset that produces more of this stuff so you can actually do something else with it, right?
That's a really good point you just raised, because Augustino, in an inflationary environment, and we saw this throughout history in Zimbabwe, in Weimar Germany, Hungary, Argentina, any example historically of inflation, people want to take their pay, their income, and instantly, as quickly as possible, convert it to stuff, to things, because the things have intrinsic value. Food has intrinsic value. Commodities have intrinsic value. The construction materials here in my home that are the walls and the ceiling and the floor and the windows, they have intrinsic value. And every human being on earth needs those things, because every human needs 3 things: food, clothing, and shelter, right? So these commodities have intrinsic value, unlike units of currency that have fluctuating value. And I'd love to share another great example, and maybe we'll close with that one.
Yeah.
Because I think your audience will really like it. So this is interesting too, because this chart shows the real mortgage payment for the last 52 years. Now, what I did here is I took the mortgage payment on the median priced house throughout the last 52 years, and then I adjusted it for the official rate of inflation according to the Consumer Price Index, or CPI. Now, we'll get to that one in a moment, because I'm sure you and I are going to agree on how the CPI is quite misleading when it comes to inflation stats.
Yeah, manipulated.
So we're gonna do another adjustment to solve for that one in a moment. Okay, but let's, in 1970, the mortgage payment on the median price house was $127. By 1980, when prices had gone up and interest rates went through the roof, as our Fed chair at the time, Paul Volcker, was trying to break the back of inflation, and he ultimately did by making interest rates astronomically high. People were getting mortgages on homes for 18%, right? You think rates are high now? Not even close. Anyway, the mortgage payment then was $520 a month. By 1990, it got worse. It was $646. And then now it's about $1,900 a month, right? That's in what's called nominal dollars. That's just the name of the dollars. It's meaningless. If we adjust them for inflation, though, according to the official statistics, then we see not 520 in 1980, we see 241. And today we see it's $257 per month adjusted for the Consumer Price Index inflation rate. So it is almost double in real dollars or constant dollars of what it was 52 years ago. But wait, there's more. Now, here's what happened. Around 1980, inflation was so out of control that the government started thinking, we got to adjust the way we calculate inflation because everybody's getting very upset. So they manipulated the Consumer Price Index dramatically to hide real inflation in the system. They do this in three major ways: weighting, substitution, and hedonic indexing. And happy to answer questions on that, but we probably don't have time to go into it. So just trust me, it's manipulated like crazy. So there's a website called shadowstats.com, and I had the founder of ShadowStats on my show before, and his name is John Williams, and all he does is calculate inflation the way the government used to calculate inflation, just the old way, to find out what is it really like today. It's not his own method, it's just the government's method that they used to use, right? That's all it is. So here's how that looks. That $127 payment 52 years ago is now equivalent to $76 today. So adjusted for inflation, we're paying not half, but almost half, about 40% less per month on the median price house than we paid 52 years ago. Now, someone will ask, well, Jason, that you didn't talk about income. Well, I'm making the assumption that people's income has kept up with inflation. That's not always true. For some people, it's exceeded inflation. For many people, they've fallen behind. But I'm simply using the two ways to calculate inflation. But here's the thing. The median price home has also changed. So we've got to adjust for the home itself because it's a different house today than it was in 1970. I mean, look, all you have to do to know this is have been alive in 1970 and known what the median kind of normal house was like back then. The house today is bigger and nicer than it used to be. Okay, it's got much nicer finishes. Look, I was watching a rerun of an old show called The Brady Bunch, we've all heard of, right? And I was watching that over the weekend, and they were standing in the kitchen, and the kitchen had these crappy Formica countertops, and it had a crappy faucet and crappy appliances, and that was like a nice house back then. Today, you got much nicer appliances, much nicer faucets, much nicer fixtures, and you've got quartz or granite countertops in almost every house, right? So it's a different house, okay? Let's adjust for the house so we're not comparing apples to oranges. Here's how we do that. The median house in 1970 was 1,500 square feet. Today, it's almost 2,400 square feet. The house has gotten a lot larger. In fact, it's grown in size by 157%. So now if we take the same table I just showed, adjusting for inflation, the mortgage payment, but let's also adjust for square footage. And here's how that looks. The cost per square foot per month for this median house, adjusted for real inflation by shadow stats, is only 3 cents per month. Now, it was 2 cents per month a year ago, 2 years ago, and 10 years ago. Now, here it was because interest rates were very low in the last couple of years, and 10 years ago, prices were very low because we were just coming out of the Great Recession. But what happened before that? Well, in the year 2000, right before 9/11, it was 4 cents per foot. It was 25% more expensive than it is today. In 1990, it was 7 cents per foot per month. In 1980, it was 14 cents per foot per month. And in 1970, it was 8 cents per foot per month. So when you really drill down on this stuff, real estate is much less expensive than most people think it is. Now, someone might be listening saying, you've thrown so much data at me, I'm confused, or it sounds too good to be true, I don't believe you. Don't take my word for it. Simply look outside. Look outside your window and look at life. And what you'll notice is that people have been and are even now with much higher interest rates snapping up houses like crazy. They're buying them. If the price was really so high, they wouldn't be buying them. Period. That's it. The market will tell you if they're cheap or expensive.
Now, do you think that that's just investors that are buying them, or would you say that's just like the average Joe that's looking to buy a house with their family? Like, who's buying it?
Good question. It's both. So before the rates shot up a couple of months ago, back then about 32% of the market was investors. And since then, that has reduced. And I don't know what the number is today, okay? But there's still a very active investor market. My company only sells to investors. We run a real estate referral network where we sign up sellers of properties in good markets nationwide, and buyers, investors come to us to buy those properties. And business is very robust, okay? So from my chair, investors are buying houses like crazy. Now, overall, the share has probably declined a bit. I don't know. I don't have the latest numbers. I have them from a couple months ago, and it was a high number, about 32%. And home buyers, when you look at the demographics coming at housing right now are nothing short of phenomenal. We have had a housing shortage in terms of construction, a construction shortage, for 16 years. They have been underbuilding. And here's the thing about that. To really know what's going on, you also have to drill down on those numbers. And I don't have any big empirical numbers to share with you. I just have a general statement on that. When you talk about the housing market and how much inventory there is or isn't, you're talking about the whole market. You're talking about every city, every county, every price segment. You're talking about condos. You're talking about single-family homes. You're talking about everything. It's a huge generalization. But let me tell you this. Nobody builds, when I say that, it is a figure of speech. Almost nobody. Just show me. Show me a new home builder that is building $200,000 houses today.
Yeah, they're all higher end. Yeah, they're high end.
The silence is deafening, right? Yeah, it's not happening. An entry-level house from a new builder today is $400,000.
All day long, yeah.
Okay, all day long, just like you say. And that, even $400,000 houses are in a massive short supply. Now, you get up to $500,000, $600,000, $700,000, there's quite a bit more inventory. So the entry-level market that investors want to buy is hugely scarce. All of the inventory numbers I shared with you a while back are particularly so much more acute and so much more pronounced in the entry-level market. And those are the properties that make good housing for millennials, the largest demographic cohort in American history, about 80 million people, right in their prime home buying years. And they are in short supply. And the demographics for the housing market for the next 10 years are just nothing short of phenomenal. So you've got a situation here where we have a very unburdened homeowner. We have a bunch of very cheap mortgages in existence of people that will not want to give up those cheap mortgages. We have a massive demographic demand coming at the housing market that's going to last easily a decade. And you have the recipe for just much more upward pressure on prices or rents. I mean, look, if they raise the rates so high and we see mortgage rates at 12%, that's definitely going to cool the market off. No question about it, right? People simply won't be able to qualify. But what are they going to do? They're going to be forced to stay in the renter pool. And that's going to put more upward pressure on rents. So either way, an investor with a good strategy wins.
That's right. That's why we're only building apartments these days. That's all we're doing, right? Because we know that inflation will continue. Money's not going to get any cheaper. And I think we're becoming a renter nation.
Yeah.
I was going to ask you, how do you see the story ending then? Are we just, is this like the fall of Rome with Wi-Fi? Like, what is all this?
That's a good one. Yeah. Well, a lot of historians have compared the U.S. in its current situation to Rome, because Rome, ancient Rome became very, they had inflation, they had gluttony, they had immorality, they had all kinds of bad things going on, right? And there are some reasonable things here, but I don't see that we have any type of collapse. We just have a slow degrading of the quality of life. And we've had that. That's been going on for quite a while, right? A hollowing out of the middle class, right? We have this elite class of billionaires and, centa millionaires over 100 million, right? There's lots of mega rich people. The typical CEO compensation now, in comparison, when you say compared to what? To the rank and file worker at big corporations, is 300 times the typical workers at these companies. 30 years ago, it was 30 times. It's just out of control. And folks, this is not a failure of capitalism, because it's not capitalism. What we have now is cronyism. Okay? We have a whole bunch of elites that buy off politicians in the form of lobbyists and outright bribery. I mean, we've got literally the world's best investor, Nancy Pelosi, okay, who trades on inside information. She's a complete criminal. We've got criminals running the government, or idiots, or both. It's just a degrading of society. Crime is spiking. They're not punishing criminals in a lot of cities. Public safety is a big concern. The education system is a disaster, and it's just getting worse. So the thing everybody listening or watching needs to do is simply protect themselves and their family by using these things that are going on for your own benefit and the benefit of, your community, right? That's all you can do. Okay. Hey, look, run for Congress. I did recommend it, but, mostly it's just there's an old quote. I can't remember who it's from, but how does the universe end? With a whimper, not a bang. Right. And that's what just happens. There's more carjackings, more robberies, more people are going to move to live behind gates or move out to the country, or just leave the United States altogether. I mean, compared to what? I mean, where are you going to do better than in the U.S.? I don't think there is much better.
That I don't know. I'll figure it out.
I don't either. Well, look, I mean, I've been to 87 countries. I love to travel. I was born in Europe, and let me tell you, I've traveled to some of those 87 countries many times over, and I don't see anybody who's better off than the U.S. We have the reserve currency of the world. We have the largest military the human race has ever known to keep it that way. And for my money, the U.S. it's pretty great, but it is in decline, no question.
I mean, and that's the thing. It's I think there's this chart. I'm sure you've seen it, where you have the Dutch. They were the primary power for 250 years, and I think it was the UK. Then it's us, and now I think we're on the decline, and now China's on the come up, right? So I don't know how much truth there is in any of that, but
yeah, I mean, I get the idea of it. No empire lasts forever. Okay, that's no question about it, right? But we're not going to be replaced by China. Let me tell you that. China is a disaster. If you think we have problems, China has problems like us 10x. I mean, the Chinese banking system is on the verge of collapse. The people in the country do not like being oppressed by a communist government. China has the biggest problem China has is a demographic problem. Because of their disastrous one-child policy, in 10 years, I mean, if you look at there's something demographers look at, and I'm a big student of demographics, because demographics are destiny, as the old saying goes. And if you look at what's called the population pyramid of China versus the US, China is a lopsided disaster. In 10 years, China literally runs out of young people. And if you don't have young people, you have no way to support old people. And the economy starts to implode. Russia, one of the reasons many speculate that Putin invaded Ukraine is because he had to do it now. Because the Russian military just lifted the age restriction for soldiers. You can now be a soldier in the Russian army at any age. You can be 65 years old and be on the front lines in the Russian military. They have no soldiers. Okay, Russia is a dying country. Japan is a dying country. Western Europe, and that encompasses a whole bunch of countries, they're all just dying. They don't have children. If you want to have a country, you have to have children. There is no way out of that. China will be over in 10 years. Japan will cease to exist in 50 to 70 years. Russia will cease to exist. I don't know what happens to these countries. I don't know how it plays out, but if you don't have kids, you can't have a country.
That's true. Yeah.
Period.
Yeah.
And the United States has phenomenal demographics, better than any major country on earth. And a lot of it's through immigration, okay? But we assimilate immigrants better than probably any country anywhere. And listen, I'm not hugely in favor of all this immigration, okay? I'm not saying that, but I'm saying that when the immigrants come, they tend to assimilate mostly, and they become contributors to society, right? But our demographic pyramid looks great. Like what the most popular age in the United States right now is?
36.
29.
29. Oh.
29. Yeah. We got young people to buy houses and support the old people. The system's going to work here for a long time. You can't say that in any other major country.
Yeah, but it's part of the culture too. I think especially post World War II, when all the GIs came back, there was that big boom that really contributed a great deal. That really got things kicked off too. So this is great. So we're coming to that point. We got to wrap things up. So Jason, if you had one piece of bulletproof advice for the listeners right now, what would you tell them?
I think we have a lot more inflation ahead. The middle class is being hollowed out. Trade your currency units, those pieces of paper with dead presidents on them, trade them for goods, for things that are functional and will help you grow your wealth. And so to repeat an old cliche, don't wait to buy real estate and then wait.
I love that one.
Augustino, just one thing before you go. I forgot to mention it earlier. Sorry. If anybody is listening only or watching and they want a copy of my slides, you can just go to jasonhartman.com/slides and grab them. Okay. So you can just download the slide deck, jasonhartman.com/slides.
Excellent. All right, guys, if you want to reach out to Jason, you can reach him via his website at jasonhartman.com. Check out his material too. He's got great stuff. Clearly, he's got the mind of an economist, and we need more people actually think about the numbers as opposed to just use their emotions to just make broad statements. It's good to have people out there that are really pushing with actual data. It's always good to have Jason on. Thanks for tuning in, guys, and I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, head up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.